Watching Your World at 10. Now, recently, consultancy firm Grant Thornton put out a report which spoke of a trend over the last decade of investors favouring large IPOs, as a result of which small and medium-sized companies are apparently losing out in adequate access to capital via the equity markets. Well, joining us to discuss this report is Harish HV, partner, National Management, Grant Thornton, India that is also. And also joining us with his views is Prithvi Haldia, the Managing Director of Prime Database, and a man well known as a primary market expert. Gentlemen, thank you very much for joining us. Harish, I'm going to start by asking you to state your case as to why you believe that the primary market in India has become a big boys market, that small IPOs are all but dead from this Indian market, and you have 1 minute to do so.
This report is based on the report that our US firm has brought out, where they argue that the US market has predominantly become a big boys market. So based on this report, we looked at the Indian market, and we are seeing some signs of this happening both in the primary and the secondary market, where the focus is predominantly on the large companies. And if you look at, for example, would Infosys be able to make an IPO with a 10 or 15 crore issue in today's market and get the kind of coverage? The answer is it is becoming difficult to do so. So it is important that we have a very healthy primary market. Now, if you look at private equity, they have invested probably in about 1,000 companies in the last 5 to 6 years. And they would, if they start looking for exits through IPOs, at the rate we are going, it'll take them 20 years to exit all the companies, if every one of their companies. So we are setting up all the private equity companies for M&A or being acquired by large boys. So we are not saying that the market has completely become large, but it is tending to that, and therefore we need to look at this.
Prithvi Haldia, would you agree with the argument that Harish is making, the small IPO market is dying a slow death in India, and that it could take private equity companies 20 years to be able to exit their investments at the rate at which small IPOs are happening in this country?
What I've just heard is a statement of fact that in terms of the amount mobilized, the top 10 issuers, for example, in a year would mop up 75-80% of the amount. And that's a statement of fact. I think what is more important is to understand why is this happening. I think it is not because there are no investors or retail investors or other investors in the market. I think three things have happened in the last 10 years. One is that the market structures have changed, and the entire process of book building, which basically ensures that 50 to 60% of an IPO subscribed by institutional investors, basically edges out entrepreneurs or smaller companies, because institutional investors would typically look at medium to large companies. So that has been a very major development in the Indian market, where we are actually encouraging, in a sense, only institution-supported IPOs rather than the market as a whole supported IPOs. Number two, I think what is happening is that, as I just heard, the research on the medium and small IPOs is very limited, and therefore there is not enough interest which is generated in these kinds of issues. And finally, I think the merchant banking industry, you see, we have seen such a dramatic change in the merchant banking industry, where from 1,500 merchant bankers we are down to 50. So unless we create a new body of merchant bankers, we really look at SME exchange afresh, because the kind of guidelines which have been issued for SME exchange are so restrictive that I don't think, 1 year down the line we have achieved nothing, and I don't think it's going to be very easy for any company to raise money through the SME exchange whenever it comes.
All right, so Mr. Haldia, you not only agree with Harish's diagnosis that there definitely is a problem here with regards to small IPOs, but you also agree that the time has come for us to work harder on an SME exchange, a concept that we've debated in this country and operationalized, or at least attempted to several times before, but has definitely not been a success.
There are many issues with the SME guidelines, and I think I have concerns on several of them, including two major ones. One is that it requires underwriting, and with the capitalization of small merchant bankers, I think it's going to become very difficult for merchant bankers to underwrite or take a stake in the IPOs that they come up with. Number two, we have a requirement of market making for 3 years. And again, given the market making as a mechanism not taking off in India for a variety of reasons, we are not going to. So if you have compulsory market making and compulsory underwriting, I think small IPOs are going to have a tough time. And that's the reason why we have not seen any activity on that front.
Mr. Haldia, you have mentioned that there are issues with regards to the operationalization of SME exchanges. Harish, if I could come to you here, because your report cites the example of Chinext in China, which is also a small and medium-sized IPO exchange or platform, if I may say so. What has China done right that we have not been able to adopt or do right in India with regards to an SME exchange?
Well, I think China has come out with separate guidelines, separate corporate governance issues, separate set of market rules to encourage that. I think we've been only debating and using the old case of OTCI not working as an example that this doesn't work. What we need is a complete set of rules which are easy for younger companies, cheaper for them, but also money making for the market participants. And it is possible, and which is what China has shown. They've already clocked about 50 issues in 9 months. So if it can be done in China, it can easily be done in India. So I think the first and foremost concept people need to figure out is the market participants need to make money and the structures need to be in place. One paisa brokerage kind of structures will always defeat this kind of market and encourage more trading than investment.
Harish, my problem with the SME exchange concept in India is that every time we talk about it, people talk of lower governance standards, fewer disclosures, and that's a highly risky process. I mean, is that how China did it? And even if China did it that way, is that a road that we should be walking down towards? Because we are still in a very nascent investor market, so to speak, in India.
Well, I mean, you don't need to have lower governance guidelines, but you need to have rules which are simpler and less expensive to follow. If you come up with Sarbanes-Oxley kind of requirements where it's going to take a lot of money to meet those guidelines, then it's not going to work. Nobody is saying that smaller companies need to have lesser corporate governance. But again, everybody should recognize that investing in smaller companies does have a higher risk because it is a younger company. It cannot afford to put in place all the processes and invest in SAP, have very expensive board members. So that is an understanding which investors need to figure out, and it will develop as the market graduates. And clearly there has to be a path for a small company to graduate to the larger exchange. But nobody is saying have lower standards, but more cheaper standards, if we may say so.
Mr. Haldia, same problem once again. This is a recipe for disaster. We already have, as you pointed out, several thousand small or insignificant companies listed that don't even trade, that are deeply illiquid, and that make for a punter's market. Why do we need to add to that list? Do we need to go out of our way to create even more risk in this marketplace so as to be able to enable a set of companies to list and, to do that, reduce disclosure guidelines or reduce governance requirements?
No, I think we'll have to take a very balanced view on this. You see, we cannot say that none of the listing agreement guidelines would be applicable on SMEs. Once you're raising money from the capital, obviously you have to be governed by some guidelines. But I think the point is that if you limit SME offerings only to institutional investors or HNIs, then you are saying that you are basically exposing this IPO to informed or supposedly informed investors who are willing to take a greater risk even with lesser disclosures or corporate governance requirements. For example, if Prithvi Haldia wants to do an IPO in Prime Database, I may not be able to comply with all the listing guidelines, but in case people think that, even without 50% independent directors, even without quarterly disclosures, even without this, they are prepared to take a risk with me. And this risk is not, passed on to small investors. So what my model would be basically to allow this to be sold to a set of institutional investors. So instead of one PE firm or VC firm taking a risk on a company, you are dividing the risk among 50, 100, 200, 500 investors.
So are you talking about an SME exchange that counts on its investor base only as institutions? Otherwise, this is not going to work. I mean, we're still at a nascent stage in our capital markets, and investors are not going to take the caution that you're pointing out very wisely. For instance, which investor is going to say, oh, they told me in advance that Prime Database, and I'm using that example because you used it, was a certain kind of company and that I was exposed to a certain enhanced kind of risk, but I really didn't know how to manage it. I mean, if Prime Database is not ready to find its place amongst the big boys in the established marketplace, may I make the argument that it's perhaps not ready to list at all, and we don't need to go out of our way to make that happen?
Yeah, it is ready to list, but when I said it should be, the investors should be limited to institutional investors, I also added the word HNIs and corporates. I'm not saying that only FIs and mutual funds and insurance companies, the so-called QIB, should be allowed to invest. We can extend this to anybody who wants to apply for 200,000 rupees or 500,000 rupees or more. So what you are then saying is that, okay, you are taking a greater risk. For example, when a PE firm invests or a VC firm invests, they know that they are investing in a company, the liquidity is not going to be there, they trust the promoters, they have some control mechanisms, and they allow the company to grow and flourish. I'm saying distribute this risk to not just one firm, but there could be 500, 1,000 institutional investors, corporates, and HNIs who may be interested in participating in this success story in the making.
Is there another solution to this, that perhaps the ideal route is maybe a QIP for unlisted companies? Or, I'm just wondering, thinking aloud, whether there are better ways to do this as opposed to trying to build an SME exchange, which has been a failing endeavor for the last decade, and, exposing investors to all kinds of risks due to, like I said, lower disclosure norms, fewer corporate governance guidelines, and saying, hey, but we've got to do this to enable some kinds of companies to come to market.
Well, I think the case for small and medium companies to have to list and grow to a larger size rather than get swallowed by larger companies is very much there, and that's what both Mr. Haldia and I agree. The route has to be one of listing where they can raise capital from a source which is independent of private equity and enable companies, enable the next Infosys to come out and grow to that size. If we don't, the next set of Infosys is going to vanish. And I strongly believe that we need a separate market for that. And clearly the risks in the market are higher, and that needs to be understood, and obviously qualified buyers need to invest in that market.
All right, gentlemen, I know when I'm outnumbered. A good thing to know that both of you agree on this. Let's hope SME exchange actually does take off quickly. Mr. Haldia and Harish, thank you very much for joining us on Your World.